Most traders don't lose money because trend lines fail. They lose money because they draw them wrong. And the worst part? Their chart looks clean, professional, logical, but the logic is fake. Pause for a second. If trend lines really didn't work, why do institutions respect structure so consistently? The problem isn't the tool. It's how you're using it. Let's fix that. First, forget the textbook definition. A trend line is not a prediction tool. It's a pressure map. That's it. In an uptrend, price makes higher lows. Why? Because buyers are stepping in earlier each time. They're defending price more aggressively. When you connect those higher lows, you're not drawing a line. You're marking where demand keeps showing up. In a downtrend, price makes lower highs. Sellers are stepping in sooner. Supply is overwhelming demand faster. The line simply visualizes control. Not magic. Not geometry. Control. Now here's where beginners destroy this. They force the line to fit. They ignore awkward wicks. They cut through candles. They keep adjusting it until it looks right. If you have to convince yourself it's valid, it isn't. A real trend line feels obvious. Clean. Natural. Respectable. If it looks engineered, it probably is. This is important. Trend lines are not about perfection. They're about reaction. Let me give you the only 3 rules that actually matter. Rule number 1. 2 touches create a possibility. The third touch creates confirmation. Anyone can connect 2 points. But when price reacts a third time, now other traders are seeing it too. And markets move when many participants focus on the same area. Rule number 2. Never force alignment. If the line has to bend reality to work, throw it away. Sometimes you'll connect wicks. Sometimes candle bodies. There's no universal formula. The question is simple. Does price respect it? Which leads to rule number 3. Strength is measured by reaction. Not angle. Not duration. Reaction. When price touches a trend line and explodes away with momentum, that's institutional activity. When it drifts through slowly, that's weakness. And most traders ignore this completely. Now pause here. The angle of your trend line matters more than you think. A gradual, shallow trend? Healthy, controlled, sustainable. But a steep trend line? That's emotional buying. FOMO, chasing. And steep trends break violently because they're built on urgency, not stability. Watch this carefully. The biggest losses don't happen at the bounce. They happen at the break. Here's the trap. Price breaks below an uptrend line. Retail traders panic. They sell instantly. Stops get triggered. Liquidity floods in. And then, price snaps right back above the trend line. Why? Because the break wasn't weakness. It was a liquidity sweep. Trend line breaks do not automatically mean reversal. They mean pressure is shifting. There's a difference. So how do you actually trade this properly? Keep it simple. 2 approaches. That's it. First, the bounce setup. Price approaches a respected trend line. You do nothing. You wait. Let price show its hand. Strong rejection? Engulfing candle? Momentum shift? The line gives context. The candle gives confirmation. Never reverse that order. Second, the break and retest. Price breaks the trend line with strength. You still do nothing. You wait for the retest. If price returns to the broken line, rejects it, and continues in the new direction, now structure has shifted. This filters out fake breakouts, because fake breaks rarely retest cleanly. Now here's another beginner mistake. Treating trend lines like brick walls. They're not walls. They're zones of pressure. Price can wick through. Overshoot slightly. Fake out. If you expect surgical precision, you'll constantly get shaken out. And one more thing most beginners ignore. Higher time frame structure. A perfect 5-minute trend line means nothing if you're trading directly into daily resistance. Structure is layered. The higher time frame controls the battlefield. The lower time frame just shows the details. So simplify this in your mind. Trend lines don't predict the future. They reveal who is defending price. If buyers defend higher lows, you align with buyers. If sellers defend lower highs, you align with sellers. If that defense weakens, you prepare for transition. That's it. Stop obsessing over drawing perfect lines. Start observing reactions. Start measuring pressure. Start asking, who is in control here? Because amateurs draw lines. Professionals read behavior. The line itself isn't the edge. Understanding why price reacts there is. And once you start thinking in terms of pressure instead of prediction, your trading slows down, gets cleaner, more patient, more intentional. So next time you open your chart, don't ask, where can I draw a trend line? Ask, where is control clearly shifting? Draw the line there, and watch how differently the market starts to look. In the next video, I'll show you how institutions trap traders around obvious trend lines, and how to stop being the liquidity. Because consistency doesn't come from drawing better lines. It comes from reading pressure better than everyone else. And that's the real edge. Amateurs draw lines. Professionals read pressure. If you're serious about becoming the second one, subscribe, and I'll see you in the next breakdown.